Which ETF actually made you more money over the last decade? Vanguard's VAS or BetaShares' A200? While they both track the Australian market, their results tell an interesting story. VAS tracks the ASX 300, that's 300 of the largest listed Australian companies. A200, on the other hand, focuses only on the ASX 200. Both include top names like Commonwealth Bank, BHP, CSL, NAB, and Wesfarmers. So on the surface, they seem nearly identical, but under the hood, there are key differences. Let's start with cost. A200 is the cheaper option with a super low fee of just 0.04% per year. VAS charges 0.10%, more than double. But VAS offers a slightly higher dividend yield, about 4.5% annually, compared to A200's 4.3%. That extra income, especially when reinvested, can make a difference long-term. So what if you invested $150 every month for the last 10 years, and you reinvested every single dividend using a DRP or Dividend Reinvestment Plan? With VAS, your investment would have grown to around $43,000. With A200, you'd have about $42,500. That's only a $500 difference over 10 years. Now let's visualize that. Here's a graph showing how both portfolios grew steadily over time. The gap is minimal, but consistent dividend reinvestment gave VAS a slight edge. Still, both ETFs delivered strong compounding results. Here's a side-by-side snapshot. VAS tracks 300 companies, has a 0.10% fee, and pays around 4.5% in dividends. A200 tracks 200 companies, charges just 0.04%, and yields 4.3%. Broader exposure and higher yield versus lower fees and leaner structure. So what's the verdict? If you want broader diversification and higher income, go with VAS. If you prefer ultra-low fees and a focused top 200 strategy, A200 is excellent. Truth is, both have delivered solid wealth creation. The most important thing? Start investing, stay consistent, and let compound growth work its magic. If this helped, drop a like, subscribe, and share it with a mate. And let us know in the comments, are you Team VAS or Team A200?